Welcome to the current federal tax developments for the week of June the 3rd, 2019. Current federal tax developments are brought to you by Kaplan Financial Education and your state society of CPAs. This week, we're going to talk about some issues that arise when you fail to sweat the details, or you end up losing out on some things. And we're going to look at a case first that deals with an individual who is attempting to claim charitable contribution deductions for his evangelizing work. And despite the fact that he seems extremely sincere, sincerity is not quite enough in this realm to get that done. We're going to talk about the Federal Circuit agreeing with the tax court that, you don't fill in the basis number on a non-cash contribution, you don't get the deduction. And that turned out to be sort of bad because the deduction in this question was $33 million worth of deductions. We also will talk about a taxpayer who lost out on $1 million worth of basis on a disposition of an asset because of lack of documents. And we get back to the what documents do you need to keep and for how long discussion our clients always love to have. And we also will find out, we closed out the week with the IRS taking one more shot. This didn't work last year, so we're going to try it this year, to develop a W-4 for the Tax Cuts and Jobs Act. As the IRS releases a new draft W-4, we'll talk about what's on it and perhaps whether or not it's going to actually satisfy parties this time. We're just not quite sure. Well, X marks the spot, shall we say, and we've got a lot of courses coming up here in June. Just wanted to quickly summarize if you're going to be around for them. Those of you here in Phoenix, I'm going to have some live courses at the Arizona Financial Planning Conference on June 8th. I'll be doing the tax update for that this coming week. On June 10th, I will be doing Nexus After Wayfair, multi-state taxation of businesses. We'll also be talking about an ethics for CPAs update, including Arizona income tax and an Arizona income tax update on June the 11th. Those are two 4-hour classes. The Arizona income tax update is going to include the law that the legislature passed here on Memorial Day that gives us our conformity based on the 2017 tax law. We finally know what that is. And then finally in Tucson, on June the 12th, I'm scheduled to do a course on preparing complex 1040s. That is going to include a session on the 199 Cap A deduction. So if you still have a little bit unsure about that, you can join us down in Tucson, and we will go over that neat stuff for 199 Cap A. Also coming up, I've got courses coming up after that in New Jersey and in Connecticut. New Jersey, I'll be doing on June the 19th. Again, the Nexus After Wayfair course, multi-state taxation, will be in West Orange, there at the Hotel Wilshire, or Wilshire Grand, I should say, get the right name. And then I'll be doing in Shelton, Connecticut, partnership taxation advanced issues. So if you're available there. And finally, I close out the month in Oregon on the 27th. I'll be doing a fringe benefits course. The 28th being doing a 199 Cap A qualified business income and other business issues from the Tax Cuts and Jobs Act. Both of those will be held in the Society's office in Beaverton, so you can be there for that course. Let's talk about what's gone on this week, though, because we've had a few things happen. First, we have a little problem here with not quite charitable expenses, and this is something that often comes up with clients who do things that they believe should qualify for a charitable deduction, but there are rules here and details. Oliveri versus Commissioner, Tax Court Memorandum Decision 2019-57, issued on May the 28th, 2019. Merely doing something good, merely doing something that is, considered a charitable item. When we talk about what can be charitable for qualifications for a 501c3, doing that by yourself is not necessarily going to lead to a charitable contribution. And this is what happened here for Mr. Oliveri. In his case, he had, and there's little doubt that he was very, very sincere in this desire. He dedicated his life to evangelization following his retirement from the United States Air Force. So he'd been in the Air Force for 26 years. He left it in 1986. So actually been doing this evangelization for longer than he was in the Air Force at this point. So he goes out and he decided after he retired from the Air Force, and we're not told that he was a pilot, but we do discover that he's giving flying lessons and he enjoyed to fly. So we got to presume that Mr. Oliveri probably flew something in the Air Force. And so that was kind of his background. Now, he decided he wanted to spread the teachings of the Catholic Church through interactions with the general public. So he did this, Now, the problem is he considers, and this is a teaching that many churches have, that, your interactions with members of the public are activities or possibilities for you to evangelize and, put forward your beliefs. And so he believed that was there. And so he thought it was his duty to put himself kind of into that position. And so he went out and he did various things. Now, he did basically wear a large invisible crucifix at all times. And, he basically was very clear what he was doing. He does that. He may runs into people in restaurants, when he travels, when he piloted private planes. He made it very clear he didn't know in advance when he would evangelize. It was just if the situation came up. Now, he did form an organization, Brothers and Sisters of Divine Mercy, although the statement said it was responsible to the Pontifical Council of the Laity, a diastery of the Catholic Church. There's no record of any formal arrangement or agreement between that organization and the Catholic Church. And he did not seek or obtain any approval of the Catholic Church for his activities, nor did he report those activities to the Catholic Church. So the problem here comes down to, it is okay to claim charitable contribution deductions for expenses you incur related to a charity. The issue is, though, that there are some rules involved here. First thing is, generally, what you incur cannot be an expense that's effectively personal in nature. So we have to have that problem. If the expense is generally personal, then we're not going to get a deduction, right? That's going to be a problem. And the tax court said in a lot of cases, there was very personal items here. I mean, he basically tried to claim deductions for like the training flights he did, because he would fly and he'd do training. And the problem the court held was that he admitted that he really liked to fly, which, again, not unusual. Somebody had been flying for, 26 years in the Air Force prior to his retirement. I can imagine he enjoys flying. I find most pilots that I've known enjoy flying, and so they'll do that. And so he would put together these flights, but he tried to argue that all the costs he incurred in putting together this cases where he would go and train somebody and be in the air and do some training, that those were all charitable events. And the court said, no, not really. It's just, despite the fact he evangelized, and he said, well, it also helped him because he got the small airports he traveled to and small towns that otherwise wouldn't get to hear his preaching. And so all those expenses he tried to claim, no, they said that really doesn't go. He also tried to claim his meals, because he said he often talked with, wait staff. He talked with people in the restaurant. He would counsel them. He would do various things. And so he thought that, because he did that so often, that essentially he took meals in restaurants to give himself the chance to evangelize. The court again said, well, that's really an inherently personal expense. You're primarily incurring that expense for the personal need that, yeah, we all have to eat at some time. And, and only if the situation presented itself did you, end up doing evangelization. So he said it wasn't really being done that way. And the bigger problem that he had ultimately, and I think this also really cost him those deductions anyway, was he didn't coordinate these expenses with a 501c3 organization. In essence, you're only going to remember, charitable deductions basically require you to have a contribution to a recognized 501c3 organization. Now, a church itself does not have to apply for that recognition. Doesn't have to apply for the status. All the charities do. But the church still has to be a 501c3. And secondly, merely being religious affiliated doesn't get you out of applying for the recognition if you're not really yourself a church. And so here's the problem. We have him going around personally doing this stuff. He would make grants. He would give money to people. He gave them books. He would do all of these things, but none of this was coordinated. And how you look at coordination is there's really 4 tests they use to see if you have close ties to a religious organization that indicates that you're really incurring these expenses for the organization. And the first one is, what's the strength of your affiliation? And remember, the problem we have here is there was no sort of supervision of him by the Catholic Church. The Catholic Church really wasn't aware of what he was doing. And I mean, we don't actually say so, but I suspect that, they really didn't endorse directly. It's like, it's not that maybe they're against what he's doing, but it's like, it's also not a program they're running. Did the organization initiate and request services from the taxpayer? No, not in this case. He basically made all the decisions about when he would evangelize and how he'd do it. So it wasn't as if, the church saw a need for somebody to go out there and do this sort of work in, let's say, a small town in Iowa. And so he went there. No, he just decided to go to the small town in Iowa and do his flight training and then maybe talk to somebody there. The supervision of his work by the organization, well, neither the Catholic Church nor his own organization actually did any supervision. He didn't report anything back to those. And does he have accountability to that exempt org? Basically, in this case, no. Again, he was doing his own thing. So because of that lack of coordination, you can't very well say his expenses were being incurred for the church. And then the final thing here, which I think is one that probably will trip up some clients who aren't quite, off in this realm, is if you incur expenses for the charity and the amounts are more than $250, you have to have an acknowledgement from the charity of your contribution. Now, what that means is effectively is the charity has to give you a written acknowledgement that you incurred those expenses for the charity. And it has to meet all the standard requirements for written acknowledgement. It has to be contemporaneous. They have to tell you what the amount is. In this case, because it's an expenditure, so they could get the amount. They have to be able to tell it that they didn't give you anything in exchange for that. And he didn't have any of these for this. Now he said, well, wait, for the organization I control, that's ridiculous because obviously, I'm doing something ridiculous. Well, ridiculous is still required in this case. And secondly, obviously, to the extent that he claimed the contribution was for the church itself, well, yeah, he didn't have any sort of documentation from the Catholic Church, that said essentially that you incurred these expenses on our behalf. So for all these reasons, despite the fact that he did a lot of things that I think, a devout Catholic would consider to be very good things, he's not going to get a deduction. It just doesn't work that way. I mean, there's more than what he's got. The fact he formed an organization to do this, we note in the case that the IRS has been on him for a while. Probably he formed the organization because at some point they said, you can't do this without operating under the umbrella of a charity. But it still appears that he didn't quite get the idea that he has to then have some records in that charity. And there has to be this tie-in and we have to, follow these rules. And no, he's doing his own thing. And unfortunately, it's going to be very tough to make doing your own thing in this regard into a deductible item. As the court said, we're not, talking about this from the standpoint of saying that you're not religious, you're not doing it, and we judged you weren't religious. We just judged that you didn't meet the requirement for the deduction. And that's true whether it's religious or not. It doesn't matter. If you were doing this for any other charitable purpose, you'd also lose the deduction. It's just the way it works. Okay. Well, now let's go on and some more charitable issues. But this one has actually brought up a case that we had talked about earlier. Earlier, it went under the name of the partnership. When it got to the Federal Circuit Court of Appeals, we're going to see it in the name of one of the partners, which is Jeff Blau versus Commissioner. This is a Court of Appeals of the DC, I should say DC Circuit, not federal, case number 17266 on May the 24th. Now, what this particular case told us was that this was a case of a contribution of some rights in land. Now, we didn't say the taxpayer. So he contributed rights in land. He did it. It was worth more than $5,000. I'd say 33 million is worth more than 5,000. So he had this contribution, a $33 million contribution the partnership did to this charity, the University of Michigan. And because of that, they claimed that deduction on the return. Now, there's the box there that tells you have to give the basis of the asset. And that's not just the A283 box. In reality, Regulation 1.170A-13C2 also requires basically three things in this case. You have to have a qualified appraisal. You have to include a completed appraisal summary, including the basis of the property on Form 8283. You've got to maintain records with various items in them. Now, in reality, the case gets a little flakier than you might suspect. And I think, initially the IRS is saying, well, look, the whole thing was a sham. The basis was they acquired this property for less than $3 million. They contribute it a year later, so they hold it just long enough to get capital gain, these rights in the property, and they claim a deduction for $33 million based on this appraisal they got. One of their requirements for the university was, in accepting it, the university had to agree to hold it for 2 years. When the university finally sold it 2 years later, they sold it for $1.9 million to a party that was kind of related, so to this organization. So it has a lot of issues that just didn't look good. But the tax court decided not to go into all those other issues. We're just going to go to the fact they didn't put the basis on the return. Now, wait, you might say, as did the attorneys who were defending this individual, this partnership, that wait, you don't need to know the basis of this property, assuming basically that we're not going to try to claim cost basis only to get the higher percentage of income. You don't really need to know it. The only thing you need to know is if that property was worth $33 million, then that's what the deduction should have been. There was no need, in essence, that was useless information. Well, the court said, sorry, guys. First thing is, Congress basically gave the IRS full authority to write this, and they point that out in the code. They said, secondly, it's not really useless information. It's really important to understand that you bought this for $3 million less than a year earlier. You're claiming a deduction for 11 times what you paid for it after a year. And that is a significant kind of huge red flag that this, appraisal might be just a bit overstated. There may be reason to worry about why is this so much more valuable than it was the year before, and that would have alerted the service. Now, the taxpayer said, well, okay, anyway, that doesn't matter. They should have taken that blank as zero. We had zero basis, and then that should have been flagged to them. And the Court of Appeals said, we might buy that, except the IRS said if for some reason you didn't know what your basis was or couldn't determine the basis, that you were to disclose that on the return. And they said, you guys didn't disclose. So the reality was you did not follow the required, what was required per the reg. Now, the IRS wanted them to go so far as to say that we don't care. There's no such thing as substantial compliance. If you don't put this on the A283, you never could get the deduction. The Court of Appeals refused to go there. Now, they said, we're not going to decide that issue one way or the other. They're saying, but here's the catch. Even if there is a substantial compliance, and by the way, the tax court believes it is possibly to substantially comply, even if you have a footfault on this. But they said, even if they're right, this is so clearly not substantial compliance that it doesn't matter. And so we're not going to go talk about whether or not, if this was substantial compliance, would it still be not allowed? They're saying that's not really the issue in this case. It doesn't matter in this case because, gang, this is not substantial compliance. So rather, we're just going to go ahead and treat it the way we've treated it. Leave it this way. Say, look, you didn't have it on there. There's no substantial compliance. We're disallowing the deduction. And so be done with it. Obviously, this is rather expensive, shall we say. It was a big loss. And fundamentally, it was, and I thought it was kind of interesting. Peter Riley, when he wrote this case up for Forbes, as he said, it's kind of interesting line in his information. He had a line saying, all the smart people with complicated math stuff planning the deal and attacking it, and the tax court blows it up with what would be a review comment a senior accountant with 3 years experience would have given an associate. Yeah. It's one of those simple things early on in your career that you got tagged for by the senior reviewing your work. And then when you became a senior, you tagged it. It's like, yeah, that's kind of what blew this up. It was the simple stuff. The simple stuff blew up the deduction. Would have survived even if they put the basis in. I think there's reason to believe there might have been issues otherwise. But, courts are really good at it. If they don't have to go somewhere that's messy and complicated, they won't go there. They'll just use the unmessy, uncomplicated way to get there. Well, let's go to another problem that the taxpayers had. Breeland versus Commissioner, Tax Court Memorandum Decision 2019-59. And this actually is one that's kind of funny because both the IRS and the taxpayers won part of the case. So it's a win some, lose some situation in this case. Here's what happened, though. In this particular case, the taxpayers had property that was foreclosed because they were unable to pay on the debt. This property had been acquired, part of the property, there was one lot in particular we're worried about, had been acquired as part of a 1031 exchange. Now, the property that was exchanged, right, the property that was exchanged in the transaction where we got this property was also acquired in a 1031 exchange a number of years earlier, or about a year earlier. So we have at least two in the chain of 1031 exchanges. And I say at least two because, to be totally honest, I could see this going back a lot further, but it becomes irrelevant the first time the chain breaks. And the chain's going to break at that second one back issue is where we're going to break the chain. And once that breaks, the problem just comes forward. In this particular case, because we have these 1031 exchanges, they took place before. Now remember, whenever you do a 1031 exchange, the basis of the property received is going to be, assuming I'm putting cash in, and net they're putting cash in all these cases. It's going to be the basis of, the remaining basis of what I gave up, added to whatever my net boot is. And there was giving up liabilities, taking on liabilities, there was cash, but there was net boot in both of these transactions. So in both of these transactions, we had property given up, and then we had some money and things we put in. Now, here's the catch. Let's go to that exchange 2 back. Okay. In that exchange, the taxpayer had, and what they gave us was they have a Form 8824 showing the exchange. They had on that computation, and they showed the basis of the asset coming in. Now, the IRS said, well, that's great, but what's the actual? So they said, okay, here's our actual. Here's a depreciation schedule from that return from a number of years ago. And it shows, depreciation, what the depreciable value of that asset was at what the adjusted basis was on the date of the exchange, which is all great and wonderful. Except they had no other evidence behind that. So the problem is pretty simple. The tax court said that, a depreciation schedule from a tax return does not prove basis, right? Proving basis requires you go back and give me a closing, or I would suspect very possibly there was another 1031 exchange, which then goes back to another 1031 exchange. So you don't know how far back this goes. But because they could not show how they arrived at the basis of the lot that was exchanged on that 2 exchange back transaction, that basis, which was just under $1 million, I mean, it was not terribly far under $1 million, that basis was lost. It was actually $988,938. That much of basis on the property that they had to give up in the foreclosure sale, that much of their basis was disallowed. Now, the flip side of it was the IRS lost on this one too, but on a different issue. On the foreclosure sale, at the time that they were foreclosed upon, the amount of debt that's shown, the balance they owed was $10,764,262. Now, they're foreclosed, they take the property. When the foreclosure sale was held, the only bidder for the property was, as is often the case, the lender, and the lender bids just over $7.2 million. Now, the question becomes, what is the sales price in this foreclosure? The IRS said, well, normally in a non-recourse debt, we all agree this was a non-recourse debt, the sales price would be the fair value of the property that had been given up. But the IRS said, and they ended up losing it at a foreclosure sale for $7.2 million. But the IRS said, but no, you shouldn't use that number because there was no appraisal ever performed. And we don't believe that's fair value. I mean, come on. This wasn't willing buyer, willing seller. The seller certainly wasn't willing. They're kind of forced to do this. and the lender kind of controls this whole sale situation. So, that was a rigged bid, the theory is. So the actual sales price was more than that. The tax court said, IRS, under the regulations, it is presumed that the price that you get in that foreclosure sale is the fair market value unless there's clear and convincing evidence of something to the contrary. And the tax court said, IRS, really, you're telling me, look, there was no appraisal made. And the court's saying, well, that's actually a problem for you, because with no appraisal, there is no clear and convincing evidence that the lender's bid was not the fair value. And under the regulations, absent clear and convincing evidence of some other number, we have to use this. So, guys, you're actually hurting your case, not helping it, by saying no appraisals were performed. It's like there is no evidence, and you don't have any here. So tough luck. We're going to use that 7 point whatever million. And IRS, you wanted to go down that route. You had to help, you have to basically go after and show why they were wrong to say there wasn't other evidence. Then they said, secondly, the IRS said, well, even if that's the case, then really, come on, he had over nearly $11 million in debt. If true, even though the bid price only $7 million, actually, it really should be treated as the $10.7 million is the sales price. Either that's the sales price, that's the real one, or there should be cancellation of debt for the difference. Well, the court said, okay, we understand that, right? In a recourse debt, you have a sale for the fair value, and then the other part of the debt, if in fact the lender does not decide to pursue collection, is going to be considered to be cancellation of debt whenever the lender, basically the way the rule works is the lender no longer intends to enforce collection, and the seller, basically, and the debtor no longer intends to pay, and the debtor did not intend to pay. That's pretty clear. At this point, they weren't planning to throw a couple $1 million in. But, the question would be, well, what about the lender? Well, as the taxpayers pointed out, they ended up filing bankruptcy. Yeah, things went bad, okay? It was bad overall. And they pointed out, look, this debt was discharged in the bankruptcy. And the court took notice of the fact that the bank filed a claim in bankruptcy related to this, saying, IRS, since that was a later year, therefore, as far as we can tell, that's evidence that it was not forgiven at the date of foreclosure. And secondly, even if that had been the current year it was a discharge in bankruptcy, which they didn't worry about because wrong year, then you would have had the exclusion under 108 for a discharge in bankruptcy. So they said, IRS, you're wrong. The sales price is not like $3 million more than what they got. So, we're going to do it based on that. So they still got a nice capital loss, but, it's $1 million less than it would have been probably had they kept the records. The takeaway from this, you need to have records to back up anything that happened at any time in the past that could influence a number that goes on this year's return. The acquisition documents for that property, even though it was exchanged years ago, the acquisition documents for that are key. If you can't establish those, you lose the basis. That's what happened here. You can't prove basis. One problem that we ran into with that is clients all the time, I don't know about you, but I have the problem. Clients all the time want to know, when can I throw documents away? When can I throw documents away? And the answer is you got to be very, very careful about throwing away documents, because throwing away documents is a problem. If you destroy things, you've got to make sure they have no relationship to any transaction that could happen in the future. And that does definitely include for people doing lots of 1031 exchanges. You need to have basically the assets, the documents going all the way back through that whole trail of 1031 exchanges, all the way back for every single asset acquisition. You can't get rid of that until, at this point with the foreclosure, we can now get rid of everything once, basically the statute closes on this year. But otherwise, we got to keep all of that train of documents to be able to prove what our basis is. That's the problem. That's what they didn't do, and that's how they lost $1 million worth of capital loss. Okay, now the end of the week, we discovered the IRS is going to try one more time to do this, because they tried it last year and it didn't work so well. So an IRS News Release 2019-98 and a draft Form W-4 posted the same time here on May the 31st, the IRS is again going to try to release a draft W-4 for 2020. Okay. Now, the new W-4 will get rid of withholding allowances entirely, right? So we're going to have this new try. So what's happened the last couple of years for 2018, we used the old style W-4 because there was no time. The IRS is going to get a new one for 19. Last summer, they tried to show us a new one, and everybody screamed because it was going to be so much calculation going on that, as they said, the party might as well just do a tax return, just work that up, and that's not really what W-4 is meant for. So they went back for 2019. They gave us again a rehash of the 17 W-4, which is interesting because it uses withholding allowances, which were vaguely based on exemptions. That's kind of where you started with them. And obviously, exemptions don't really matter much in the current code. So, we're using something that doesn't really work. And, and I can argue maybe it never worked under the old system, but everybody kind of got used to how the numbers worked, and they got the level of refund or whatever they wanted. If their situation didn't change dramatically, they, always got what they wanted. So they were happy. But now we're on this new system where, things are very different, and you can't just use this kind of stand-in to take how many dependents do we have. That's not a good way of standing in for this. So now we're going to get another try at the new W-4. The new W-4 there are 4 pages involved in this thing. The first page is the actual form. The second page has instructions. The third page has 2 worksheets that are used in computing some of the steps. And the fourth page has a series of tables that's also used in computing adjustments in step 4. So we have these 4 pages involved. Now, in a simple case, we have a taxpayer, standard deduction, single, 1 job. That person really will literally just fill in their name, address, check the box single, and sign it, hand in the W-4. That's all they need to do. But what about the case like for a married couple, where you have 2 different W-2s? That was always the problem before. Or what if you have an employee, somebody who's working 2 jobs? Well, the IRS has special calculations for that. And the catch is, if you have income from more than 1 W-2 going up on the tax return, you go to step 2. Now, there they actually give you 3 options. Option number 1 is to go to the calculator at www.irs.gov/W4app. And that's basically calculating everything just like the old W-4, that W-4 they're going to try last year. And they make it clear that's going to give you the most accurate computation. But secondly, if you don't want to do that, you can use worksheet 1 on page 3. And what that does is it walks you through a series of steps, kind of like the old worksheet, but it's going to give you an additional amount, and you're just going to put this amount. So add to what, add or adjust whatever you compute above, right? Do this. So we're going to go through that, and that will go there. Now, that only goes there on the higher earning job. You're supposed to put it there for the largest W-2. That's going to be the key. If there are only 2 jobs, so let's say I have a job, my spouse has a job, and we each have, only 1 W-2, then I can just check a single box in step 2, and it'll kind of be the highest withholding. So what they tell you is it'll warn you that'll lead to having excess tax withheld, but it also means they won't likely have too little tax withheld if we only have 2 jobs. And obviously, I think that's to try to address all the yelling we got at the beginning of this tax season about refunds being unexpectedly lower for a while. Now, that all kind of washed out as the year went on, and it came pretty even. But there was, it would appear to me, at least in my experience, a bit more variation. Numbers were much larger refunds, or it went the other way. So the average was pretty close, but obviously the people who are going to screen the most are the ones that, were expecting a refund, and all prior years had gotten one of those 4-figure refunds every time. And this year they suddenly owed $1,000, and they were the ones who are going to scream the loudest. We always know that that's going to be the key. So we're going to have a box saying, just make sure I get a refund. That's not really what it says, but that's the goal of it. And, then we go to step 3. Step 3 is only computed for basically for 1 job in the household. If it's the highest paying job, that's what you're supposed to use. And it takes into account like what other deductions you'll have. It kind of checks if we go over the standard deduction. It takes a look at deductions maybe that don't require to itemize, like IRAs. And that gives you 1 adjustment, 1 item. And then they do a second calculation for income not subject to withholding that you want to have counted in this. So what you're going to give them is this kind of deduction number on one line. You're going to give them an income number on another. You're going to give this adjustment amount on the third line. Now, what we don't know so far is how that's going to translate into the amount withheld from a paycheck, because what we don't have yet, although the IRS expects to release it in the next few weeks, is the actual side for the employer computation. And that's going to probably be what we're going to need before we can really figure this out, is we have to do that. Now, the IRS did release a frequently asked question page. They published at the same time, which has 20 questions. And you can look at that and kind of work through some of how this is going to work out the employer in. They do indicate they expect to release a new near final version, second draft, in mid to late July, with the actual final version issued in November. They want to get that really close to final version in November, because this is going to require some reprogramming of systems, because you're not just going to get a number of exemptions number and have to work from that. Now, they do tell you on the frequently asked questions page that employees don't have to fill in a new W-4. And so it's going to be a way to map from the old system. There's going to be like old system exemptions. You can still use that, not for new ones, but they can keep using it for the old ones. So essentially, and I think the IRS believes this, look, if that number came in about what they liked last year, maybe we just leave it there and don't mess it up. But if they want to do it in more detail, we can go through this. And new employees should go through this, because otherwise we got the other thing that just doesn't work. But if it kind of works for them, we can leave it. And that will take over. Now, this is going to be more interesting, I think, on the employer side too. First thing is this still too complicated for individual employees? I don't know. My guess is we're going to hear some complaints about that again this time, but it is simplified from what they had before. I think a more interesting aside is going to see how the employers react to it when we get the employer numbers, and how the payroll people talk about the reprogramming is going to be necessary to get payroll systems ready to run on January 1st using this new withholding system. So again, this is try 2 for the IRS. Remember, under try 1, they got yelled at a lot. So will this one fare any better, and will it help? I don't know, but stay tuned. And by the way, the IRS is looking for comments on this. So if you have constructive comments, don't just say, I hate it. I think that's probably, we need something a little better than that. But if you've got some comments about how they should handle it, be sure you take a look at it and then go to the IRS website and leave your comments on these, or comment on this form as noted on the website. Well, it is that time of year. It is, hey, graduation time. In fact, I spent, I'm actually recording this on Friday, late afternoon. I actually spent last night at the graduation for Arcadia High School here in Phoenix, sitting there looking out over the bleachers in the football field and looking across at Camelback Mountain. Yeah, it's like I remember my high school graduation, the view my parents had, and the people that came for me was not of a mountain in the background, just standing there majestically. No, I think you either got to look at various school buildings, or if you're on the other side of the field, you got to look at essentially the parking lot. But yeah, Arcadia got a better view. So I was there last night. This is a time to make sure that you get your education put together, though, for your own stuff this year. Just as you probably were aware for quite a while, merely going in there and having your graduation cap on and leaving college did not suddenly mean you didn't have to worry about learning anything on taxes. Everything's gone. In fact, as we all knew, everything we learned in our college tax course was basically outdated by the time we ever actually touched a return. Just kind of the way it works. Same thing about the CPA exam. So get out there, do it. We've got a lot of things going on in the CPE world. Take a look. All your state societies are up and running now. So get yourself ready to go. We'll see how things run. But take a look, sign up for your courses. Like I said, I'm going to remind people we've got courses running. I got a number of them running in June. So again, for those of you in Arizona, Connecticut, New Jersey, and Oregon, take a look at that. I'd love to see you guys out at those courses. This has been Current Federal Tax Developments again for the week of June the 3rd. You can catch our regular updates during the week at currentfederaltaxdevelopments.com. If you have any questions or comments, you can send them to me via email, edzollers@currentfederaltaxdevelopments.com. I do post on Twitter. Whenever I post something on the website, I put it up at that location. I also get involved in other tax discussions. I don't do a whole lot on Twitter that is not tax related, so you're not going to get in there. I'm not going to go off on some, nice long discussion about the day's political thing of whatever the political hot button issue of the day is. I don't spend time on that. So, we try to keep this feed to just the tax side as we can. So we go there. And also, I do have discussions on various subreddits or on subreddits and discussion groups. You can follow me on /r/taxpros on Reddit. If you want to go there, that's a place you get into. I do, as I mentioned every week, I follow the discussions on the Connect sites for the Arizona, New Jersey, and Minnesota Society of CPAs. Also follow along somewhat on Tax Talk for California Society. So if you have access to those, get in. Every CPA in the country has access to Tax Talk. You just have to get into Yahoo groups and get permission to go in. But anybody licensed as a CPA in any state has a right to get in there. So that's a place to follow as well. And, it's a nice place to discuss, especially a place to bounce ideas off people. With that, though, it's going to be another week. Hey, this week we discover remember, they took a week off from the retirement bill. Well, starting on Monday, they have a chance to go at it again. So we'll see what happens. And if we get a retirement bill out of there next week, or if this turns out to be one of those things that hangs us up for a long time on the dispute over the 529 provisions, just have to keep your eyes on it. Sure, it's exciting stuff, right? Yeah, sit down with your popcorn and watch C-SPAN, and we'll see how this all works out. But we'll see you next week, either way, with a new retirement bill or not. We'll see you next week and talk about what's gone on and what's developing in the area of federal taxes.